Hey, hello everyone. Welcome back to chapter 7, self-employment, and it should be an interesting chapter. So let's go to chapter 7 to see what we can do. So we are going to compare and contrast the reporting of income and deductions for cash versus accrual basis, which we kind of covered that before, but we look at it fast. Distinguish between self-employment income and income not from self-employment, recognizing the expenses deducted on Schedule C, and understanding the home office deduction that can be taken, and compute the sole proprietorship self-employment tax. Self-employment tax is about that FICA taxes, Medicare and Social Security taxes. Okay, so let's see one by one. So on the cash method, taxpayers report income when they actually or constructively receive it. So the income will be recorded and recognized only when you receive cash. Taxpayers constructively receive income when it's credited to their account or made available to them without restrictions. So if you receive a check, right, that means it's available to you. You cannot say, oh, I'm going to hold on to this check till January, then I will deposit that. So that doesn't make sense. It's still a revenue. So you have to recognize the revenue because the check was available to you. So an example here is on December 31st, Carson receives a check for $200 in payment of fees earned. Carson constructively received the $200 in 2021, even if the check cannot be cashed until January 2nd. Therefore, Carson reports the $200 as income in 2021. On December 30th of 2021, Jamie receives a check for $500 as payment for services rendered. The customer informs Jamie that the check will bounce if cashed before January 2nd of 2022. Because the funds are not available until 2022, Jamie has not constructively received the $500 in 2021. Jamie reports the $500 as income in 2022, and here is the important part: documents the customer's assertion. So you have to have documentation. You cannot just verbally say that. Make sense? So customer has to send you an email or something like that, or in return that the check will bounce if you deposit that. But in example 1, the check was good, but only problem was it was like holiday. So if it's a holiday and you cannot cash the check, still you have the check. That's income. But the example 2, the customer said in written document that the check will bounce if you deposit that. So that means December 31st or December 30th, they cannot deposit the check. It will bounce, so it's not available. And one more example, Scott receives 10 shares of stock in exchange for services rendered. The market value of share of stock is $28. Scott reports income of $280. So fair market value is the best way to recognize the revenue that you earned by receiving the cash or something like stock. Under the cash method, taxpayers deduct expenses when they pay the cash, but only if the expenses relates to the current or a previous tax year. taxpayers usually. That means you cannot pay for something that belongs to next year. Got it? You cannot say, oh, this year I want to show a lot of expenses. Let me pay $10,000 of my rent that I need to pay next year right now. So if I do that, then I will be able to recognize more rent expense.
What if you pay it early for some other reason, just because you want to do it because of the way your cash flow is, that you pay it early? Do you just not show that expense until the next year? Because that's when it's...
That belongs to the next year, yeah.
Yeah, okay.
Yeah. But I suggest if your cash flow permits, put that cash in your saving account and don't pay to someone.
Don't pay it early.
Don't pay it. Why do you pay money to someone in advance?
Wait, so if you did, let's say your contract started June 2022 and you did a 1-year prepaid insurance and it would end June 2023, that would only be for 2023, even though
You recognize only the insurance that has been expired because of that insurance policy for that year. The remaining is, prepaid insurance for next year. You cannot buy 3 years, 2 years of insurance policy, let's say today, and say, oh, I have a lot of insurance expense this year because my income is high. I don't want to show too much income. Okay, so on September 23rd, Min pays $36,000 for 2 years insurance coverage. Oh, this is your question, actually. That begins on October 1st of 2021. Okay, October, November, December, that's 3 months. Although Min is a cash basis taxpayer, she cannot deduct the $36,000 payment in 2021. Instead, she deducts 36,000 divided by 24, whatever it is, multiplied by 3 months, and that will be insurance expense for 2021. Ming will deduct 18,000, which is the remaining 36,000 times, divide by 24, which is 1,500, 1,500 times 12, that's 18,000 in 2022. And the rest, whatever is remaining, you cannot push that more than that. Has to be recognized in 2023. Make sense? Even though if this is 5 years insurance, still you cannot push it more than 2 years. Okay, accrual method. Under the accrual method, income includes amount earned or accrued but not received. Like revenue that you earned it, but you didn't, you just send an invoice and you recognize accounts receivable and you have to recognize that revenue. Some customers, every business, when they declare to IRS that we have a business, they have to tell to IRS, is it accrual method or cash method? IRS wants to know that. That's the first question, literally.
What's accrual method?
What is accrual method? Accrual method, that means you recognize revenue when you earn it, not when you get paid. Let's say I prepare your tax return this year in 2023, so I earned it. Now I send you an invoice, but you say, I will pay you in January of next year. Okay, but still I earned it. And still is a taxable income for me because I do my business accrual basis. And same thing for expense. If you use or receive some type of service or goods and you have the obligation to pay that moment, it's an expense. Doesn't matter if you paid that or not.
Like a tax return for a business, one of the form you ask, is it
What was that?
On like a tax return for the company, on the form, would it ask like, the method or cash method?
Yes, every business. The moment you tell IRS, I have a business, the first question is it cash method or accrual method? Which one you are using? And you have to say which one right there.
You can't change it every year.
No, you can't change it unless you contact IRS, explain why you want to change it, and IRS sends you a confirmation that, okay, starting this year, you can do that, no problem. But you cannot just change this year to accrual, next year cash, and then year after that, accrual again. No. Questions? Yes.
Another company takes over another company. I'm guessing they use their own, like if company A is cash basis and they take over company B, which is accrual, company A would still do cash basis after they acquire company B.
Depends how do you take it over. If you just buy the assets of the other company, so still you're gonna use your company, but you purchase the assets of other company, and the other company literally is gonna be dissolved. Or you say, no, my company is gonna stay, and I purchased the other company too, so it's gonna be a like sub account of your company, but both companies, they have to file separate returns. In that situation, you follow whatever it is, separate returns, cash or accrual basis. So it depends how you merge. Okay, so here there is a problem. Example, on January 3rd of 2022, an employer pays salaries that his employees earn for the week ended December 31st of 2021. Under the accrual method, the employer reports the salaries as an expense in 2021. Under the cash method, the employer reports the expense in 2022. Because on the cash method, he didn't pay yet. But under accrual method, you have to recognize your obligation, and your obligation is paying salaries because they work for you and now you are obligated to pay. So it doesn't matter you pay or not, it's still an expense. So it depends what type of accounting method you are using. Most large companies, they are accrual method. Sole proprietorship, most of them, I'm guessing it's gonna be cash method because those are individuals, and individuals normally they do cash method in their tax returns anyway. So, every situation is different, but that's overall what I think. Okay, Kent is in the business of selling and repairing televisions. On April 1st of 2021, Kent receives $1,200 for one of his customers for a 2-year warranty contract. You see, this is a 2-year period, okay? Kent spread his prepaid income over 2 years. He reports 450, which is 1,200 divided by 9. 1,200 multiply of 9 out of 24 months. That's the April through December, 9 months. So 1,200 times 9 out of 24. And that's 450 on his 2021 return. The rest will be on his 2022 tax return. Kent must report the entire $1,200 in his 2022 returns, even though some of the services extended into 2023. So the revenue, the revenue for warranty needs to be recognized in that year for the months that has been earned, but the remaining balance in year 2 needs to be recognized. Specifically for warranty, they are very picky. And if the warranty is is provided by a third party type of company, not the same company, then has to be recognized immediately, all of it. But here Kent is not a third party. Kent himself is in the business of selling and providing warranty himself. That's why IRS let him to recognize a portion of the warranty insurance that he sold in year 2021 and the all remaining balances in year 2020. The exception that allows accrual method taxpayers to spread out prepaid income over 2 years does not extend to prepaid interest and most prepaid rent. It also does not extend to prepaid warranty income received by a third party. So that was what I was trying to refer to, third party. A third party provider is one of who did not sell the goods being warranted to the customer to whom the warranty is sold. So it's sold with another company, not the seller of TVs, let's say. Taxpayers who sell the goods being warranted to the customer to whom the warranty is sold. Taxpayers who receive these types of prepaid items report the full amount in income in the year they receive it. So same as fact example 6 here, except that Kent offers the warranty contract as a third-party provider. Then Kent must report the entire $1,200 in 2021 because it's a third-party provider.
So are they saying, sorry, that prepaid interest and prepaid rent, you also have to take the full amount?
Yes, prepaid income and prepaid
Prepaid interest and prepaid rent.
yeah, prepaid. Because again,
A lot of money.
yeah, if you receive prepaid, if you receive income that is prepaid in advance, then you have to, because you received it already, so you have to recognize that. If you receive interest in advance, someone borrows money from you and they pay interest in advance. Interest and revenue has to be recognized immediately. And also, if you are accrual method of taxpayer and you provide a service and you don't get paid, again, for the amount that you provided, you have to recognize that also in the income. So if you get prepaid or you provide the service, send an invoice and didn't get paid, either way, you have to recognize the revenue.
If for some reason you don't get paid, the person, never pays you, you take it as a loss.
Then later on, you write it off. You write off as a bad debt expense.
You have to do it as a bad debt expense in the next following year, or do you have to amend?
Under IRS, you can have direct write-off, not for bookkeeping purposes, because GAAP doesn't accept it for big companies to do direct write-off. They have to recognize some form of allowance for doubtful account in December 31st. But for IRS purposes, that means tax purposes, you can write it off moment that you believe that accounts receivable will not be collected. And that is debiting bad debt expense and credit accounts receivable for that customer to write it off. Another question, I saw a hand maybe? No, you're good? Okay.
Anything accounts receivable?
Yeah, debit bad debt expense, direct write-off. Debit bad debt expense, credit accounts receivable. That way, the accounts receivable will be closed and bad debt expense will be recognized. And that you recognize that bad debt expense. Why? Because a year ago, let's say, you recognize revenue for whatever you earned and you send an invoice. 6 months later, you still didn't collect that.
Let's say somehow you collected, the guy comes and,
If later on the
yeah.
guy
something-
comes back and pay you back,
Yeah, yeah.
if the guy comes back and pay you back at that situation, because you already write it off, so you have to again recognize two journal entries. First, debit accounts receivable for whatever the check that you received from that bad customer, debit accounts receivable, and credit revenue. That's journal entry number one. Journal entry number two, you take that check and you deposit in the bank, which is debit cash, credit accounts receivable. So in order, if someone feels bad and wants to continue business relation with you and pays you the amount that has been written off already, so you have to do that two journal entries. First, recognition of revenue, which is debit accounts receivable, credit revenue, and then deposit the check. And as soon as you deposit the check, the journal entry is debit cash, credit accounts receivable.
Can you then, you leave it at the bank or do you just withdraw the fund?
You first deposit the check, right? And then in order to withdraw the amount, you can withdraw anytime you want, if it's a sole proprietorship. If it's not a sole proprietorship, you cannot go to corporation checking account and withdraw because you like it that way. You have to withdraw for a business purpose, like for filling out your petty cash. But in a sole proprietorship, the owner is a sole proprietor. So the owner can withdraw money anytime he wants. And that will be called withdraw or owner's withdrawal. And owner's withdrawal will be caused to reduction of owner's capital at the end of the year.
Even personal,
Huh?
even personal, like a personal withdrawal as a sole.
There is no personal withdrawal.
It's just business.
It's a business checking account.
Yeah.
You withdraw, you call it owner's withdrawal. And owner's withdrawal means the owner's capital goes down. Owner's capital goes down, that means you have less basis. And if you sell the business a month after that for higher amount, the difference between owner's capital T account balance and the selling price of your business will be capital gain. And that means the withdrawal that you did a month ago now will cause you to pay higher capital gain, because the withdrawal that you did a month ago, it will reduce your owner's capital, and now you sold your business. The difference between owner's capital and sold amount ends up to be capital gain, and you have to pay taxes on it. That's why it's very important when you have partnership, taxation, and self-employment, Schedule C type of business, you need to make sure that your client understand and you understand that you have to constantly follow the basis of that business, the owner's capital and basis, because if not, then you will end up into a situation that IRS will say, since you don't have any proof of your owner's capital and you are not following your owner's capital, documenting owner's capital, then the whole thing that you sold for your business is sold, the whole thing, the whole amount is capital gain. So the only way to skip that whole amount capital gain is from day one that you start your business, you constructively follow the owner's capital balance and you document it or journalize it. So your owner's capital is constantly up to date, up to the moment that you sell your business, or even close your business. Let's say if you close your business, you have a loss. Okay, how much loss? So you have to go base up the owner's capital loss, right? And if you don't have any owner's capital documentation and journalization of owner's capital, so IRS says, what loss? What loss you are talking about? Okay, so that was a lot of extra information here, I believe. So Schedule C, only self-employment income and related expenses reported in Schedule C. Very important. If you don't do that, then you are mixing your personal assets and things with your business, and then IRS will all of a sudden say, you know what? Nothing is permitted. All your revenues are revenues. All your expenses are not permitted. So all of a sudden, every single dollar you generate, it's a revenue. Why? Because you start mixing up your personal and business expenses together. You open the door for that, claim of IRS to denying all your expenses. And also, that self-employment, if you use Schedule C, that means you are sole proprietorship, and under sole proprietorship, there is unlimited liability. So make sure you know that and your client understand that. That's why you want to switch from Schedule C to S Corp or LLC or something as soon as possible, so you can limit that unlimited liability to limited liability. Let's see. Those are the details that you can read. Oh, this one is a good one. Rental income from real estate. Make sure it's not on the Schedule C. It goes to Schedule E, right there, Schedule E. Okay. So if you have clients, they have also rental income. Don't put it in Schedule C. Unless the client says, I am a real estate broker. So he is in a real estate business and he's actively managing it and he has a license. Then that's different story. Then now we have a business. And most of those brokers, there is no way they become a sole proprietorship. It's like suicide. They are definitely an LLC or something like that. But most real estate, it's a passive activities. Here you see it says passive activity. And because of passive activity, it goes to Schedule E. Gain and losses from sale of business property other than inventory are not reported as part of business profit or loss on Schedule C. These gains and losses are reported on Forms 4797, sales of business property, and appear on separate line item from business profits on Schedule 1. Make sense? So if you have an equipment, let's say, and you have a used equipment and you sold it, now you have a loss on sale of equipment, or you might have a gain on sale of equipment. You report that on Form 4797, sale of business property. You say, when did I buy it? How much was the basis? When did I sell it? And so on and so forth. So that way you can report that gain or loss and goes in Schedule 1. However, if you sell any inventory is an asset of your business, but the purpose is to sell it and make profit. So it is your business profit, and it does go into Schedule C. If you have inventory, that means you have cost of goods sold. If you have cost of goods sold, then you have to tell what type of inventory tracking are you using in your accounting. Are you using first in, first out, FIFO? Are you using last in, first out, LIFO? Or you are using average costing? Or a specific identification method? Specific identification method are for those type of inventory that you can specifically track it. For example, jewelry, because when you make a jewelry, it's a specific work. You make a stock number and you sell that specific jewelry. You know exactly what the cost of goods sold is for that specific jewelry. Or let's say automobile. Every automobile that the dealer is selling has a VIN number, and the VIN number is a specific identification method. But if you are selling t-shirt, then okay, so you bought t-shirt for $10, $11, and $12. So you have 3 t-shirts. Each one of them is on a separate cost, $10 and then 11 and then 12. So which t-shirt did you sell? You sold just one t-shirt, but which one? IRS needs that also. Right at the beginning says, what are you doing? Do you have a cost of goods sold? Yes. Check that box. What type of accounting method are you using for your inventory costing? FIFO, LIFO, or average? If you are using FIFO, that means the first t-shirt that you bought it for $10, you just sold that. That means if you sold it for $25 and your cost of goods sold is $10, so your gross profit is $15. Simple like that. If you sell the LIFO method, if you do accounting for inventory on LIFO method, then you sold the last t-shirt. The last t-shirt, you bought it for $12 and you sold it for $25. The sales price is always $25. That's not, it's kind of same thing all the time. So 25 minus 12, your gross profit is $13 and you pay taxes for that. Now, if you want to go with average, again, IRS wants to know. So if you go with average, IRS says, okay, you have inventory average costing of 10 plus 11 plus 12. That's 23. 23 divided by 3. That's $11. So your cost of goods sold for the t-shirt that you sold is $11. Sell price is 25 minus 11, gross profit 14, and you pay taxes for that.
When
Yes.
businesses, well, I guess they should know when they're setting it up, but like, are there typical businesses that fall into those different types of accounting inventory methods?
Yes, you have to choose day one.
I know you have to pick, but like, do some businesses, how do the businesses decide which one to go into?
Which one you want? It's your choice.
It's just choice. It's not like, you know, clothing manufacturers tend to do average and, you know.
It's just 100% optional. Like oil companies, for example,
Like their prices, but.
they like LIFO. But for example, most businesses in general, they use FIFO. Why? Because they say, just like water that comes in a river, first comes, first goes out. First t-shirt you buy, that's the first t-shirt you sell. It makes common sense.
Yeah.
So FIFO. But some businesses, they like average, so they go with average. And there is an economic reason also for oil companies. Let's say they use LIFO because they want to pay less income tax momentarily. So they really like LIFO.
Oh, yeah, I forgot about that, yeah.
Under LIFO, you always sell the item that you bought it the latest. And normal items that you bought it the latest are the most expensive one. And that's why if you have most expensive cost of goods sold, then you have less revenue, less net income. Less net income means paying less income tax, at least at that year. Okay, so IRS also permits LIFO. There is no LIFO permit under international law as far as I know. They don't like that. But for IRS in the US, LIFO is permitted. Okay, so let's see what's here. Maybe I can find something. Let's read it a little bit. Net profit derived from a business operated as a sole proprietorship is taxable, of course, right? And net loss is deducted in arriving at adjusted gross income. In computing the amount of net profit or loss, sole proprietors subtract from business income the cost of goods sold and all deductible business operating expenses. To be deductible, expenses from a business must be ordinary and necessary. So you cannot make it up, okay? And some of your clients, they push you to make up some expenses. You don't do that for its operation. Also, the expenses must be reasonable in amount. The expenses is ordinary if it is customary or usual in the taxpayer's line of business. An expense is necessary if it helps taxpayers' business. So it's important it is to be related to business. You cannot make up expenses. The cost of capital expenditure, which is assets lasting more than 1 year, such as truck, office machinery, and building, are deducted over several years through annual depreciation deduction, unless you choose to use that bonus depreciation that we talked about with others. Sole proprietorship reports net profit on Schedule C, which we talked about that. So you can look at the structure of a Schedule C. I might have it here. Here's a Schedule C that you can see. Either you have your sole proprietorship, so you can use the social security number of the sole proprietor. Principal, business, or profession, whatever it is, business name, if it's different. Sometimes you leave the social security number blank and you enter your employer ID number if you have any employer ID number and over there. Business address and accounting method. You see, I said that's the first question here, accounting method. So it's a cash or accrual. Did you materially participate in the operation of the business? Normally you say yes. If you started or acquired this business during 2022, check here. Normally, if this is your first year of business, definitely you check that box. And you get these questions in the software also, so make sure you answer them correctly. Did you make any payments in 2022 that requires you to file Form 1099? That is very important questions. If you say yes, make sure you file all those Form 1099s for independent contractors. And here, if yes, did you or will you file required 1099? And the answer should be yes. Gross receipts goes in here. Return and allowances goes in line 2. Return and allowances is a contra account to sales to receive to net sales. So you have gross sales less return and allowances gives you net sales of line 3. Got it? Do you know what's the difference between return and allowances?
Yeah.
What is it?
Well, return is when they return goods, and allowances if you're giving them a discount for paying early, like a 3%.
No. No. You were close, but no. Okay, you open another question opportunity for me. Okay, let's go to returns and allowances. Returns and allowances are if your customer buys a t-shirt and returns the t-shirt. That's a return, physical return. That means you put the t-shirt back in inventory to sell it another time to another customer. But allowances is different. Allowances is when your customer comes back, says there's something on the t-shirt that he doesn't like, and then you tell him, okay, you have two options. Either you can return it or keep the t-shirt, I give you 20% discount. And customer says, okay, give me 20% discount, I keep the t-shirt. So that 20% discount that you provide, that's a return allowances. That's not return. Okay, the other one that you said, it's a sales credit. Sales credit means the seller is providing an invoice to the buyer and says the terms of this invoice is 210 net 30, 2/10, comma, and net 30. That means, for example, you can change those numbers, but I'm just using one of those as a sample. So 210, that means 2% discount if you pay in 10 days. Otherwise, if the customer pays in 10 days. Otherwise, the whole amount of invoice is due 30 days from the first invoice date. So customer needs to decide if he wants to pay in 10 days and take advantage of that sales discount, or just pay in 30 days and pay the full amount. And that 2% honestly is not 2%, because that 2% is only for receiving the payment 20 days in advance. Otherwise, if client stays up to 30 days, has to pay the full amount. So that 2% is just for 20 days. That means if you convert that to annual rate of interest rate, it ends up to be 36.5% annual interest rate. So that 2%, it's a huge interest charge that the seller is charging the client because the client wants to pay this invoice late after 10 days and wait till 30 days. But if the client is smart, definitely they never pay 36.5% annual interest rate. They only pay sooner in 10 days and avoid that 36.5% annual interest rate. That's repo, right? Okay, so cost of goods sold will be deducted in line 4 from the net sales, and that gives you gross profit. Gross profit is a dollar amount that you have available to pay for operating expenses. And gross profit minus or plus other type of income, whatever tax credit or whatever refund you receive, you add that in line 6. And finally, line 7 is the actual gross income. Then from gross income, you will deduct in part 2 all your expenses. And if you look at those expenses, you will see we have advertisement, we have car and truck expenses, commission and fees, labor contract, depreciation, employee benefit program, like providing them, let's say, health insurance or something. Insurance, like liability insurance, not health insurance. Where does the health insurance go? Anyone? Health insurance. We covered that like at least 3 times. Health insurance never ever goes in Schedule C. Health insurance does not go in Schedule C. Health insurance goes in Form 1040. And the deduction is maybe on one of those schedules, Schedule 1 or Schedule 3, something like that. But it's not, health insurance is not. So if you have a sole proprietorship and you pay health insurance for yourself and your family from your sole proprietorship, do not put it in here. Health insurance goes in Form 1040.
1040?
Form 1040, in one of those schedules. I don't remember, Schedule 1, 2, or 3, but one of those schedules, which eventually goes in Form 1040. But liability insurance goes in line 15. You see that, liability insurance?
What would be an example of liability insurance?
Like insurance that you buy in case someone sues you,
Oh, okay.
or
What about-
even car insurance.
Oh,
Car insurance goes there. So if you have liability insurance and automobile insurance, then you have to create 2 line items, but combined goes in line 15.
what if you have employees?
Health insurance,
Yeah.
line 14.
Oh, that's the benefit, okay.
Line 14. line 19 says pension and profit sharing. So if you have those pension and profit sharing type of expenses that you contribute to those, either for yourself or for your, I'm not sure, honestly, but definitely for your employees, that it goes in here. For yourself also goes in here. But I just double check it, but it goes in here, line 90. If you have any interest, mortgage or those type of things, legal and professional services like bookkeeping or anything, tax preparation if you pay anything, office expenses, rent or lease for vehicle, machinery, equipment, business properties, they have to identify what it is and use that rent or lease that you pay. Repair and maintenance, supplies. Supplies are like office supplies, something like that. Taxes and licenses, travel and meals, utilities, wages, other expenses. If you don't know what like something, if you have something that it doesn't fit in any of those, then put them in other expenses and identify that line item with the name. Okay,
But
so
what is reserve for future use?
what was that?
The 27B part, the reserve for future use?
Yeah, IRS kept that line. It was something there probably before, but it got,
Oh, it's reserved for future use of the form, not
yeah.
money that you paid.
No,
Reserved
it's for
future.
IRS to use it in future, yes.
Gotcha.
For the meals, I know you can say you like have lunch with someone and that's like a business meeting. What kind of, I guess, proof would the person need to have to show with a business meeting?
It has to be a specific location, you have to document that. It has to be specific times, the specific date, with a specific business client, which you are entertaining that client for that meal. So it has to be documented properly, and I believe 50% will be deductible.
Would like if you guys were communicating through text, could a screenshot of the text be okay, or would an email be better?
How do you pay for a meal? Do you go to a restaurant or something?
Yeah.
Okay, then you have to have a restaurant receipt, restaurant location, address, purpose of business meeting, purpose, why you are meeting
Yeah,
over
like
there.
usually we write on the receipts. We put the names of who were there on it.
50%, not 75%.
No, 50%. Who was in the meeting? What was the purpose of the meeting? Everything. So anything that IRS might ask you about that, you have to have documented. There's no verbal answer. It has to be documented, including the receipts. Because so many people like to go to eat and say, oh, that was a business meeting. With what? With who? For what? When? How? All those questions comes into action. And the IRS is very picky on those.
I should say, I've never been audited that way to know what I'm doing is good enough.
Yeah, I know someone who was audited, they always put business meetings and they got fined. That's why I was curious.
Yeah, IRS, as soon as they see business meeting food type of things, and it's not just one, and it's like several of those type of things, IRS says, you know what, let's talk. It looks like you are smart a little bit. So let's go over those expenses. Cost of goods sold goes in here, and it says, okay, how do you calculate your cost? Is it, let's say, based on cost? Are you following lowers of cost or market valuation for your inventory? Or you use others type of costing? So that's also attached explanation. And what is the inventory at the beginning of the year? all those information that you might, done in your business, like purchase less cost of items withdrawn for personal use. So maybe you bought some items, like t-shirts and, but you took 2 t-shirts for yourself and leave the rest of those t-shirts in the inventory. So those 2 t-shirts has to come out of that calculation. Cost of labor, materials and supplies, other costs, add them up, that inventory at the end of the year. Normally, if you make things yourself, like make t-shirt, there is 3 things going into making a t-shirt. Material, which is fabric, whatever it is, labor cost, and overhead. So you combine those to calculate the cost of the inventory that you have. So those are the lines that you normally use for calculation of cost of goods. And if you have vehicle, it says, when did you place the vehicle in service for business? Needs exact date. Now, business mileage, commuting mileage, and other type of mileage that you use. Only the business mileage will be used for calculation of mileage fees.
So I have a question about that. Like I have a friend who recently purchased a vehicle strictly for business. But it's not moving right now because she still has to finish up some extra paperwork. And which she should be done by next month. So that means the vehicle's been sitting and she's been paying, but it's not moving.
Paying for payments.
Paying for the payment. So what happens to those months that it's not moving, but it was purchased for the business? It's just, she can't get it on the road till she finishes up a couple.
When did you place, the first question, line 43. When did you place your vehicle in service for business purposes? He will put the date that the car goes into business. You might buy it in January and then you put it in business in September because the business was not ready yet. So all those 9 months is nothing. You just place that car into business in September and you put September over there. And then you say, okay, now I put in business in September and the business mileage I use is this much. And you put that mileage. And you have to have a mileage log, very sophisticated mileage log.
So then all the money that she's been paying on the note for the car note, for those months that's just sitting there, it's just, you can't claim that.
Depends if you are using actual expenses or you are using standard mileage. If you are using standard mileage, then you go with mileage. You might use 10,000 miles this year, 10,000 miles next year. So 1,000 miles multiplied with the rate, standard mileage rate. And so that's the, like, you don't want to go with actual expenses. Actual expenses like maintenance, gas, all those type of things. Now you have a car, so you bought a car, so the car that you bought it, you will also capitalize. So you buy a car and you put in service in September, and September, October, November, December, that's 4 months of depreciation that you need to recognize for the car. So the car is, let's say, $100,000 car. Okay, that's your capitalization of the truck, $100,000, and that's truck is normally 5 years useful life. So you put in service in September, so it's the first 9 months. It's a half-year convention, and
Would it be half year? Wouldn't it be the quarter one since it's bought in September?
no, you bought it in January. Remember my example? I said you bought it in January, but you put it in use in September. September is 9 months. Is not month 10, 11, 12.
Okay.
So it still is in first 9 months.
Okay.
And that is half-year convention. And you recognize the depreciation. So you recognize the depreciation separately, plus you recognize the standard mileage for instead of fuel expense, insurance expense, tire expense, brake job expense, all those maintenance stuff instead of using actual expenses, which is painful process to keep all those documents. So you just use standard mileage, which is much easier. All you need to have is just a log.
So the depreciation that you take on that depreciation, which I can't remember which form that goes on, it doesn't go as part of the business.
Yeah, it will be depreciation expense here.
Oh, sorry.
Somewhere,
Yeah, line 13.
line 13, yeah. Right there. So depreciation is depreciation, I got it. But how about the oil change, brake job, tires, gas, everything is expensive. How do you want to count that? That is either actual expense or standard mileage. I suggest standard mileage, it's much easier.
But what's the more beneficial?
I don't know. Depends what
Depends
you're driving. Are you driving a Cadillac? It's very expensive to maintain, or you are driving a Toyota. If you are driving a Toyota, maintenance is low, so you can, standard mileage may be better. Okay, so we got that part right. And, what else? Do you have evidence to support your deductions? Yes or no? Do you? And you know why they ask you here? Because you're gonna say yes or no. If you say no, you get audited. If you say yes, then they say, oh, you said yes. Now looks like you were lying. So since you were lying and you don't have it, but you said yes, then whatever you are trying to prove, it's not permitted. All your expenses out of window. We count all your revenues as a revenue and no expense. Or if they are really nice, they say, okay, we let you to use a little bit of expenses that we kind of guess it might be there, even if you are honest or not, but the rest will not be permitted. And that's the best scenario. Here, one more question. Make sure you answer this. Was your vehicle available for personal use during off-duty hours? Yes or no? If maybe someone says, no, this car is strictly for business, then the answer is no. Do you or your spouse have another vehicle available for personal use? If you say no, then they say, then the business car is personal use also. If you say, yes, I have another car for personal use, then they say, okay, maybe the other car that you say is 100% business, maybe you are right. But most cases, that's not the case. In most cases, you have a business mileage and you have personal mileage. So IRS, if you say, no, it's 100% business, they will get really picky on proving that you have 100% business or not. Okay, so we covered a lot of stuff, honestly. So we went over Schedule C, item by item, yes. I covered all this, which is, again, you can read it obviously and learn better about this. Okay, we covered all this stuff. And mileage, one more time, sometime mileage first 6 months has a different rate, standard mileage rate, than second 6 months. So if that's the case in that year, make sure you follow that log properly so you can enter those. That is part of questions when you prepare tax return for year 2022. So the client says, I have a car, I have all the mileage, everything. And then the next question is, okay, how much mileage was the first 6 months? And client needs to provide that information. So here is an example of that. So the customer, let me go over one at least. In 2022, Terry drove 6,000 business miles and 20,000 total miles. He drove half of those miles in each year, in each half of the year. Okay, got it. In 2022, Terry had used the actual cost method and accelerated depreciation to deduct expenses related to business use of his car. Terry expenses for the car in 2022 are business parking and tolls, depreciation. You see, Terry is capitalizing the truck and recognizing depreciation for $4,000. Gas, actual; insurance, actual cost; license, actual cost; oil change, actual cost. So total is $5,620. Under the actual cost method, Terry deducts $1,756, which is $5,520 or what? Or $620. It's a typo. Times 6 out of 20. That gives you a ratio, and that ratio will multiply with 5,620, and that's 1,756. Oh no, wait a minute. Oh, the business parking, $100. That's something that he has to pay no matter what the percentage of business use or personal use it is. Make sense? Because even if you use it for 5% business, still you have to park it there, right? And you have to pay that $100 because that specific parking belongs to the business parking cost. So that's why they are separating $100 business park as 100% tax deductible, right? But the remaining 5,520, which is, depreciation, gas, everything like that, that is something that relates some portion to business, some portion to personal. That's why you go with the ratio of business and personal use. Got it? That was a good tricky part. So be careful on that. Since Terry used an accelerated depreciation method in 2021, he must use the actual cost method in 2022. Had Terry been able to use the standard mileage rate method, his deduction would have been $32,615, which is before July 1740. 3,000 miles times 58 cents, and after July, 3,000 miles times 62.5 cents. Total is 1740 plus 1875, ends up to be 3615. But he used accelerated depreciation. If you don't use standard straight line method and you use accelerated depreciation, then you have to use actual cost, and that would be 1756. Make sense? But because if he use so-called, let's say, straight line method, straight line method would be maybe, let's say, $3,000 depreciation, for example. So $3,000 depreciation plus 3,615 mileage, that will be 6,000, let's say 615, and you multiply that with the ratio of this, plus the $100 business, that would be different, 100% tax deductible anyway. So
You would add the parking on separate from the mileage?
parking has to be separate because, as I'm saying, either you use 5% for business or 80% for business. That $100 you have to pay no matter what. So IRS says, okay, that $100 parking, it's 100% business. No issue on that. But the rest, you have to, you got it? But the rest, you have to go with a percentage of business and personal use. Multiple.
In that bottom line number, that total, the 3,650, you're saying plus he would have been able to do the depreciation plus the parking. So he lost.
Keep the parking $100 all the time. That should be there. Okay,
Plus
don't,
depreciation.
let's focus on depreciation. Let's say this Terry is using a straight line depreciation. And under straight line depreciation, let's say, I'm just throwing a number. Let's say it's $3,000. It's not accelerated, but it is straight line. Actually, I can kind of guess if under straight line accelerated would be, I don't know which year is this, but I'm guessing if this is the first year, under accelerated, it would be $4,000. Then under straight line would be $2,000. So $2,000 for straight line depreciation. Okay, that's good. And then, assuming this is the first year, $2,000 straight line depreciation, and then plus 3,615. So it will be 2,000 plus 3,000, $5,615. $5,615 multiplied by 6 out of 20, which is 30%. 6 out of 20 is 30%. So 30% times 5,615, which is 3,615 plus 2,000 straight line depreciation. So it might be a little bit different in regards to actual or standard mileage. It's not going to be that much huge different in normal conditions unless some specific extra cost is involved in actual cost that you maybe want to see which one gets better results. But you might try and see which one is better and stick to that. But here it says because he used accelerated depreciation, then he has to use the actual expenses.
I'm a little bit so confused on why in the first example, they even put depreciation as part of these expenses, because depreciation, isn't that gonna fall in a different spot on the schedule C?
I know that, but still depreciation plus all your expenses,
Okay,
right?
they're just trying to give you, to show you the difference.
Yeah.
That's not where-
The depreciation, you want to put it in that separate line, right? Let's go to that schedule C. You want to put it in here, right? Line 13, right? So how much depreciation will you put it there? 4,000? No, 4,000 times 30%. So 4,000 times 30% goes in line 13. But then you want to put go to other expenses here and line up all these things.
Gas, insurance, tax.
Yes, gas, insurance, license tag, all those things. You want
Wouldn't
to,
that fall under, can you go back to schedule? Wouldn't that fall under, line item 9?
Contract expense.
yes,
Yeah.
it goes there. That's why I say, before you start line iteming something, make sure you go over these expenses. Let's say advertisement, right? If I don't look at here, I might say, oh, advertisement, let me put it in other expenses, right? And it happened to me. I put something in other expenses, which I was so happy with my job. And then I came back to Schedule C, for example, I saw, wait a moment, advertising has a separate line in here. Oops, I put that in other expenses. So it takes more time from me because I have to go back from other expenses, delete that advertisement expense, let's say $300, and then come back in the software, find where the advertisement expense will end up in the software, because every software is different, right? Remember, software doesn't look like this. Software, and every software is different. So it depends what software you are using. You have to find out where that advertisement expense is in the software, because it is, oh, click here and you see all the expenses right there. Oh, I saw it. Okay, I put advertisement expense right there. And kind of, you make that mistake once or twice, and then kind of you remember that, okay. And normally I open a Schedule C, just like this, when I'm preparing taxes for a business, just kind of reverse, come back to this form, kind of see, do I have advertisement? Yes, okay, I'm gonna put it in here. Do I have car and truck expenses? Yes, line 9. Okay, I'm gonna use that. But let's say, do I have a type of expense that is not in here? What should I say? I don't know honestly, but if something is not in here, then put it in other expenses. If you have, let's say, repair and maintenance, I go to repair and maintenance and I list things that belongs to repair and maintenance. But if it is car related, then because line 9 specifically it's showing you that, then go over there and choose to have actual expenses, check the box for actual expenses and enter your actual expenses in here. If not, check the box that says standard mileage, and then you end up somewhere here. Answering those questions and then entering the mileage that you want to. Okay, so this is good enough. So we covered up to standard mileage and actual expenses for the car. We follow this next time when we meet, okay? Thank you so much and see you next time.